First of all, thank everyone for joining us today. My name is Wes Bean. I am the Chief Investment Officer here at McCarthy & Cox. We're joined by Brad McMillan, who is the Chief Investment Officer at Commonwealth. And we just wanted to offer a webinar out here, or a chance to talk with our clients a little bit, hear Brad's perspective. And there's been a lot going on with the markets and rallies and sell-offs and everything else, and it's been really volatile. And I think the real question that is on a lot of people's minds right now is, how worried should we be about this? So I'm going to turn that over to Brad and say, Brad, how worried should we be about this right now?
Well, Wes, I think that's a great question. I think everybody is worried about it. And from a certain perspective, we should be worried. You look at inflation, it's at a 40-year high, or it was, in the past couple of months. You look at the headlines, we have a recession, and you say, wow. And you think back on a recession, and what I think for a recession is, I think 2008. And I think, oh my God, it's the end of the world. Yeah. And, we're getting that reaction from a lot of clients, but the truth of the matter is, things are actually not that bad. When you think about a recession, what do you think about? Well, if you're an average person, you think about losing your job. Well, people aren't losing their job. In fact, we're seeing more and more people getting hired. We're seeing the number of people getting hired about twice the level that it is when we typically see a recession. So, in terms of losing your job, generally speaking, not that big a problem. When you talk about a recession, you talk about people not spending money, not going out and shopping. Again, you look at the aggregate spending data, people are out there, people are shopping, people are spending. So when you look at the numbers that say, yes, we're in a recession, first of all, they don't mean we're in a recession, because that's not actually how recessions work. Second of all, when you look at the underlying data, it's just these weird technical adjustments that came from the pandemic. It's not really that people aren't working, people aren't spending, that businesses aren't investing. So if this is a recession where we're adding 500,000 jobs a month, I don't think we have a lot to worry about. So am I worried? No, I'm not worried. Am I paying attention? Yes, absolutely. But when I look at the data, I feel a heck of a lot better than I do when I look at the headlines.
Yeah, that's a really good point. We see that here too. And a lot of what we hear is traditionally 2 quarters of negative GDP. Some people are, they hear that and say, okay, we're in a recession. And then to your point, we have a strong jobs market. People are spending. It's what should we really look at to figure out how we should move forward? I mean, we hear all these differing data points, and some things say yes, everything's okay, the economy's strong. Some say things are slowing down a little bit, and I think that's what's confusing. And then you have the debate: is what's the definition? Is it 2 quarters? There's other factors that come into play, and there's just a lot of back and forth in the media about, are we in one? Are we not in one? What should we really look for? Any thoughts on that, or why there's so much more, it seems like, this time, as far as, are we really in a recession or not? Or any thoughts on that?
Well, I think I'm going to go a little bit inside baseball here. Not that I normally do this, but I think it helps to understand where the numbers are coming from and why I'm not concerned about them. There's 2 ways to measure how big the economy is. The one you normally see quoted, gross domestic product, adds up everything that's bought in the economy over a period of time. And that's where we've seen that go down a little bit, because in aggregate, as it's measured, people are buying a little bit less this quarter than last, and last quarter as well. But there's another measure, one that doesn't get reported, gross domestic income. And in theory, they have to be the same, because everybody's income as a result of somebody else buying something have been pretty much the same, but not now. Now we're seeing GDP, people buying stuff, go down a little bit. And we're seeing GDI, people's income, up. And it's up by a lot more than the GDP is down. So when you look at that, and you know that, in fact, the GDP numbers typically get revised over time, they get revised literally on a regular basis. Yeah. And you know that historically, typically the GDP gets revised in the direction of the GDI, because that's easier to measure. You say, wow, we're probably going to see those GDP numbers revised up. So what does that mean? Well, suppose one of those 2 quarters gets revised up from minus whatever it was to plus 0.1. Does that mean all of a sudden we don't have a recession? We went from having a recession to not having a recession. That's kind of silly.
Yeah.
What it does mean is that we have a slowdown, per your point, Wes. But when you look at the data, that slowdown doesn't look a lot like a recession, even before we look at the jobs data.
Okay. And that's, I mean, it's good to hear. It's reassuring. I think our clients like to hear that. And, you know, we look for positives when the market's been down this year. We look for positives where we can, and we like to look and see if maybe things are going to be a little better down the road. Maybe things might get a little better towards the end of the year, into 2023. And it's a more constructive environment that we're in right now, given that you can go out and buy a shorter term bond and earn 3% or so. And a year ago, we couldn't even fathom that. So that's one positive. Another piece of that is that our clients do ask is, when does some of this trickle through to like bank rates, savings rates, checking accounts, things like that? So when do our clients see some of the things that are generally associated with higher rates, better rates, and stop seeing a lot of this negative? So what kind of a lag period is there between when the Fed takes action and then how that translates into banking products, things like that?
Well, it depends on what it is you're talking about. If you're talking about things that make banks money, like mortgages, you see the higher rates go right through lickety split.
Yeah.
When you talk about things that cost banks money, like paying your depositors more money, that takes a longer time. So we're probably looking at another 6 to 12 months before that fully translates into what's going to the clients. And the other thing is, I mean, when you look at fixed income investments that your clients have, they've obviously been affected by the higher rates. But what's interesting is over time, the short-term damage looks bad, but over time, you're going to be reinvesting at those higher rates. So over time, you're going to come out pretty close to even. So it'll take a while, but it will happen. I mean, we're already seeing that here at Commonwealth. Things are translating through, and we're getting there.
Yeah. Okay. And the gas prices, we've seen that pull back a little bit for a number of reasons. I've read online, I haven't personally experienced this, where like flights, things like that are coming down a little bit. So it does at least feel like there's a few things here and there that we can see in our day-to-day lives that might be, say, turning the corner a little bit as far as inflation. Does that kind of jive, for lack of a better way to put it, with kind of what you're saying, or what we're thinking overall with the broader economy?
It does, Wes. I think you're exactly right. When you look at, we actually just got both the CPI, the Consumer Price Index report earlier this week, and we got the Producer Price Index this morning. And both of them showed substantial drops. Now, there's a couple of reasons for that. One is the gasoline prices that you mentioned, and they've come down sharply, really, and they're probably going to keep going down for the next month or so, but then they'll probably bounce a bit. But even looking away from gasoline, we're all looking at the underlying things like services costs, and we're starting to see those pull back as well. Now, make no mistake, inflation is still way too high. But the real question is it getting better or it's getting worse? And after several months of it getting worse in a big way, we're now seeing it get better. And when you look at the underlying data, we're probably going to see that continue as well. So what does that mean for the markets and for the economy? It means we're probably close to the point of peak damage. And we can probably expect to see the economy start to pick up, real wages start to pick up, and hopefully the markets react positively as well through the end of the year.
And I think that makes a lot of sense. And it's always, when we're talking to our clients, it's easier said than done. We say, let's give this some time in the market, not timing the market. Let's let this play out. So we can talk to our clients about that, and our advisors here can talk to our clients about that. What would you say to those clients when they ask, hey, should I keep investing? Say, we do have some people that are investing monthly, or people that are maybe retiring in a few years or something like that. And so they have maybe a different time frame and different situation. So what do we say to those people, or what would you say to those people? Should we keep investing? Should we pull some money out? What should we do? And is there anything other than and sit tight. Like we tell our clients, stay in the market. Is there anything else that you would say that might make them feel a little better?
Well, I would absolutely agree with what you're saying. I mean, stay in the market. That's what builds wealth over time. But you have to ask yourself why that works. And the reason it works is because the U.S. economy keeps growing. And I mean, I know right now regardless of which side of the political divide you're on, there's always somebody who's unhappy with where the politics are.
Yeah.
You know, when Barack Obama was elected, I heard from people saying the market was going to tank. When Donald Trump was elected, I heard people saying the market's going to tank. You know, when Joe Biden is elected, you know, pretty much anytime anybody gets elected, there's a group of people out there saying it's the end of the world.
Yeah.
But if you go back and look at the market and the economy, you really can't pick out whether it was a Republican or a Democrat administration. The U.S. economy is largely independent of Washington, and thank God for that. So, you know, you're not betting on the administration. You're betting on the country. You're betting on all of your fellow citizens. And over time, we're going to continue to grow. And as far as the ups and downs of the markets go, do you like to buy stuff on sale? Because when the market goes down, you're buying the stock market on sale.
Yeah.
So stay in, not because we're telling you to, but because it's just the smart thing to do, to bet on the United States.
Yeah. Okay. No, I think this all makes sense. And I know our clients generally, you know, they trust us, they listen to us, and they stay invested. You know, there are times when it gets jittery or clients get jittery and it gets scary. And part of that is when the market sells off or, you know, we start the media, I think a lot of times too, like just headlines and things like that. You'll see a lot of that. And clients will some of them are retired, they'll watch CNBC, and it's just a lot of negative headlines out there. And the point you mentioned earlier about gasoline prices coming down and having a large impact on the inflation coming down a little bit, that was minimized yesterday a lot when I was watching like the evening news. That was minimized, but I seem to remember when gas prices were going up and contributing to inflation, they didn't necessarily point that out. They said, "Wow, inflation's horrible. It's 9-10%." And so the media, I feel like, plays a pretty big role in a lot of this. And so that's part of it. So is there anything in particular that we've seen some things like CPI, PPI coming down a little bit? Is there anything else that we should really watch for in the coming weeks or months that may confirm that this is actually working, what the Fed's doing is working a little bit? Or is that something that may take a much longer time to play out? What are your thoughts on that?
Well, I think there are two things that we need to keep an eye on. When you look at the economy, basically the economy is us, you and me, people working, people spending. That's over 70% of the economy. So, and the major part of the rest of it, the business world, depends on the consumer. Mm-hmm. So when I look at the economy, the things that I look at are, first of all, jobs. You know, are people working? Are people making money to spend? Because you can't spend the money if you don't have it. So that's why I'm so encouraged by the job numbers. Second of all, I'm looking at consumer confidence, because it doesn't matter if you have the money to spend if you don't feel good enough to spend it. Mm-hmm. And there we've seen consumer confidence drop significantly over the past year or so. And that's a bad thing. But when you look at where it actually is, it's still about the same levels we saw in about 2015, 2016. Mm-hmm. So it's down, but it's not terrible.
Yeah.
And with gas prices dropping, that's one of the primary determinants. So we can expect to see consumer confidence come back. And again, so the question is, are things getting better or are things getting worse? Things have been getting worse for a while. Yeah. Chances are things are going to get better, but those are the two things I'm going to be watching most closely. And right now, the prospects for both are good.
Okay. And we've seen, when reports come out and companies, NVIDIA that pre-announced or made an announcement on Monday, the stock sold off a little bit, but it was more initially, and then it came back. I didn't look today, but I would imagine over the past few days, it's probably gained a lot of that back. So it just seems like when companies do things like that pre-announced now, it's not as bad as it was even a month ago. And if you think about Netflix, and that's just the first one that comes to mind, when they reported first quarter, second quarter, the stock was obliterated. And it doesn't seem to be that bad because companies have potentially been pre-announcing more and more and more. And so a lot of the bad news was priced in. And so when we get something that's remotely positive, I think that's leading somewhat into what we're seeing with like a rebound in some of the markets and things like that. Does that seem accurate?
I think that's exactly right. There's a tremendous amount of bad news in markets.
Yeah.
And one way to look at that is to figure out what investors are paying for future earnings.
Mm-hmm.
People are really confident they're going to pay a lot. Trees grow to the sky. If people are getting scared, then they're going to say, "Yeah, I'm not going to pay so much because I don't really believe in those earnings numbers."
Yeah.
And what we saw, one of the biggest things that drove the drawdown in the market in the first half of the year was those valuations, what investors were willing to pay, were starting to come down. And part of it was growing pessimism about the economy. Part of it was rising interest rates. That was a big part.
Yeah.
But in both of those cases, we've seen those trends start to reverse. So when you hit the market nadir, when it was at its bottom, that was investors really pricing in higher interest rates, continued inflation, and really worrying about earnings. But as things are coming in, as you said, Wes, maybe things aren't that bad. And we're starting to see that sentiment change. So that's what's gotten us the rebound we've had so far, which has actually been reasonably healthy, and which might drive more of a rebound going forward.
All right, and if you could tell us when the market bottom has happened, when the top's going to happen, and all that, that would be great. We could really use that information here. But the economy, you touched on this. The economy is a little different than the market, or like there's the economy, there's us, we work, there's a professional side, there's the consumer that spends, and then here in Marysville where we are, we have a few large companies here, but we have a lot of smaller businesses too. So there's there's a disconnect, I think, at times in realizing that the market is not the economy, the economy is much bigger. The market's going to react a certain way looking forward, and it's not based on everything that's happening. So I know there's people feel different right now than the actual than the economy actually reflects, if that makes sense. Is there anything else that anything else that you see that would reassure people, or anything you look out for that you say, if I see this, all bets are off. I'm really going to cash or whatever. Is there anything that would throw up a big red flag for you down the road or the coming months or anything else?
I think the real question here is, when we talk about a recession, we talked about it a little bit earlier. A recession is when things get scary. And as I noted, I don't think we're in a recession. I actually don't even think we're close to a recession. And there's a bunch of reasons for that, which we can get into if you want. But the thing that would make a recession that would affect the average person would be jobs.
Yeah.
And jobs are the thing that not only does it translate into the economy as a whole, but it also most directly affects your average life. So when I look at jobs, I'm watching the layoff numbers, and they've moved up. And you can read about that. That's the headline. They've moved up. What the headline doesn't say is they're still quite low.
Yeah.
And they're especially low as a percentage of the labor force. If I started to see job growth really dropping down, that would concern me. And as an early warning indicator on that, I would look at the number of job openings out there.
Okay.
Now that has gone down from where it was, but there's still several million jobs available that are more than we've normally had in the past.
Yeah.
There's still a huge excess labor demand. So I think the earliest warning sign I'm going to watch is the number of job openings.
Okay.
Because when that starts to go, ultimately that's going to feed through into slower job growth. But right now, as I say, we're still very, very positive.
Okay. All right. Thanks. I appreciate that, Brad. And we did get a question in I wanted to ask you for one of our clients here. As interest rates rise, the interest on our national debt will rise. isn't this bad, and is this a ticking time bomb?
Yes and yes.
Yes and yes. Okay.
But the question that's the short answer.
Yeah.
I guess the question in how to think about this, though, is because I've gotten this question before, obviously, and just looking at the math, absolutely, it's a problem. But the real question, from my perspective, is this a solvable problem? And the answer is yes, it is. I can give another hour talk on what can be done and so forth, I don't think anybody has the time or the interest, but the idea being every single time in the past couple of centuries, we've run into these seemingly insoluble problems, most recently during the financial crisis.
Yeah.
When there was a real chance that things were going to fall apart.
Yeah.
And there were people out there, and I was one of them, who said that, oh, no, there's nothing that can be done. The Fed doesn't have the authority. The government doesn't have the authority. And guess what? They went and did it.
Yeah.
And they solved the problem, and the world didn't come to an end.
Mm-hmm.
So I can think of ways to solve this problem that don't actually involve anything at the moment illegal. I mean, politically, it's not an economic problem. It's a political problem. And the great thing, Wes, is it's the old Winston Churchill quote. You can always trust the Americans to do the right thing once they've exhausted all the other alternatives. That's what we're in the process of doing. But it is a solvable problem, and happy to get into that if whoever wants to talk about it.
We'll schedule that for next month, I believe. We're going to need more time, but so there's things like with this, the Fed balance sheet, and the balance sheet's going to start running off, and I think they have, and that's going to add some additional pressures, or at least the thought is that will add some additional rate hike type, pressures on things. But we tried this before, and there was the taper tantrum. I think our clients, it seems like, are concerned about that and what might happen with this. And when we do try to go back or normalize the balance sheet, normalize rates, which we're in the process of doing, and this and I think it's just, there's a lot of the stuff, a big national debt. We have this Fed balance sheet that's just huge. There's a lot of stuff out there that I think our clients are sitting back saying, okay, we have to pay the price for this at some point. Or is there a way to fix it? And I think you seem to suggest there probably is at some point. But how I think of this, and I think of a 10-year kind of time horizon, or a long time horizon, as far as like getting everything off the balance sheet and getting us back to a more normal type environment. Does that seem reasonable? I mean, I'm not necessarily thinking this is something that we have to have a solution for or think about or anything else for the next, however many years. It just seems like it's further down the road when we may have to actually pay the piper, so to speak, if we have to. Does that make sense to you? Does this sound reasonable that, at some point we will have to address this. The government will have to address this. But you seem to be saying there might be a way that this is not just catastrophic, I guess, or it's not, the end of the world at some point.
It's not the end of the world. And the mistake people make is thinking that government finances are like our family finances, because at some point, if I take out a loan, if I buy a mortgage, if I buy a house or a car, the bill's got to be paid.
Yeah.
And I'm getting close to retirement, so that bill's got to be paid sometime in the next 10 years or so.
Yeah, same here.
The government can kick the can down the road indefinitely.
Yeah.
And with a growing population and with a growing economy, they don't necessarily need to pay back that money on a sustainable basis.
Yeah.
And in fact, we've only seen the government pay back the money twice.
Yeah.
Once after World War II,
yeah,
and once in the late 1990s.
Yeah.
So, the notion that, we're going to have to pay the piper someday. Well, so far that's proven to be untrue.
Maybe not. Yeah.
And for the people who say that, no, it's mathematically inevitable, I'll give you one counterexample. Japan has had worse macro fiscal structure and debt structure than we have for 30 years. Maybe it's a long-term problem. That's okay. I'm 57. I think if we got 30 years, I'm okay with that. It won't be my problem at that point. But yeah, we can keep going.
You don't look a day over 40. So that's good. What Ukraine, the Russia and Ukraine, the war conflict, whatever we want to call it over there, like that changed things a lot. And I know the Fed came into the year, and economists, everyone came into the year, and I don't think that was base case for a lot of people. It was certainly a possibility, but it wasn't base case. So how much has that truly changed the outlook, slowed things down, sped things up, whatever that, how much has that really impacted things in your opinion? And also, do you think that led, people said the Fed was wrong. Like they said, inflation is transitory and all that, but we had other things happen, like zero COVID policy and the war in Ukraine and Russia. Do you think that's exacerbated this problem to a big degree? Is that, we obviously were aware of it, we see it in the news, but I just want to get your input on how much you think that's actually affecting things.
Well, when you look at the data, I mean, the short answer is when you look at the global economy, the impact of Ukraine is surprisingly small at this point.
Yeah.
What's interesting is we went through a period there where it added massively to inflation.
Yeah.
Through two categories. One is energy. When you look at Russia is one of the largest oil exporters in the world, and that just went away.
Yeah.
So what happened to oil prices and gas prices? They went up. That's a huge part of what we saw for inflation. Yeah. Both Russia and Ukraine are also among the largest food exporters. Mm-hmm. So we saw food inflation spike, and that also hit inflation hard. So a lot of the inflation spike we've seen this year, not all of it, but a lot of it was a direct result of that. Mm-hmm. What's interesting is we've seen the markets normalize. We've seen markets start to come back. We've seen the supply chains for those things start to figure it out. And we're not seeing those prices anymore. And that's why I say the impact is surprisingly small. I would have thought that impact would have lasted longer, but the fact that it isn't suggests that maybe we don't have as big an inflationary problem going forward as we thought.
Yeah, I think, Brad, I think that makes a lot of sense, and it's good. It's good to hear for our clients. I mean, just us talking about it doesn't necessarily change. It doesn't change the data for sure. It doesn't change what's going to happen for sure, but it's at least seeing some positives to offset all the negatives that we see in the press. It seems like, and on the food and the food situation. So Ukraine and Russia, I think, are both pretty large producers of wheat, and I think there's another potatoes. There's something else, wheat and grains, and we've seen in the news like the ships are blocked or not blocked and everything else. How much of an impact could that have? I mean, I would say 2 months ago, a lot of the folks that manage, say, commodities funds, things like that, they were talking about food inflation and specifically this situation in Ukraine and Russia as being one of the next big headwinds, I guess. And obviously things have cooled off a little bit since then. But do you have any thoughts around that? Is just kind of the same that we saw with oil and everything? It will play out at some point, or what do you think around that?
When you look at food, you have to take the geographic differential into consideration, because when you look at the average percentage of their income that an American spends on food, and then you look at the percentage of that spend that is actually devoted to the raw materials like grain, it's actually pretty small. So for a developed high-income country like the United States, it's going to have an impact. And the fear-driven impact was bigger, but actually, there's a real impact, but it's not going to be nearly as great as everybody thought going on. So here in the U.S., it's in the markets. We'll deal with it. It's not that big a deal. Yeah. We're not the problem. The problem is elsewhere in the world. The problem is in the poor countries. If you look at Africa, the Middle East, Southeast Asia, you're probably going to be looking at millions of people at risk of hunger, maybe worse.
Yeah,
that's where the damage is really going to kick in. And that's where I think the thing we as investors, we as human beings need to be prepared to help alleviate that hunger. We as, good Christians or good whatever religion you happen to follow, we need to be prepared for that. But we as investors have to think through what that means politically for our investments. And that, I think, is where most of the food impact shows up.
Okay. I think I asked this a little bit, but any reports or anything that you're going to pay particular attention to? CPI, PPI just came out. The Fed it's next month. I believe that they have their next meeting, or September. What is there anything different than that you see coming from the Fed, or is it going to be more about the rhetoric that Jay Powell has at his press conference afterwards, or any thoughts around that?
Let's actually, that's a great question, but let's take a step back here and talk about, when we see things like that, how should we not, to me, it's not about what the number is, what they say. It's about how that factors into what people expect them to say, especially what markets expect them to say, how that relates to how it changes those expectations. So when we talk about the Fed, for example, what do you think? What do you think they're going to do next month? 50 basis points or 75?
75.
All right. I think you're probably right. But does it really matter that they're doing 75, given that it takes 18 to 24 months for the interest rate increase to really carry through the markets? Or does what matters if they do 50 instead of 75? Or if they do 100? So that's the shock in the information. So I'm watching for shocks. I'm watching for differential.
Yeah.
To track how worried you should be is the yield on the 10-year U.S. Treasury. And it went up from very low levels up to about 3.2, 3.25. And everybody was freaking out because it had been years it was that high.
Yeah.
And then dropped back down to about 2.8. That says to me, people were worried. But now people aren't that worried. So that's the number we need to watch for. And that's what I'm keeping an eye on after the Fed meeting. Did it change expectations? And if so, how much?
And incidentally, which part of the yield curve do you look at personally? There's inversions and we talk about 10 and 2 month, 10 and 2 year. What do you look at? Just curious as far as is the yield curve inverted? Is it not inverted? What metric do you look at there?
Most of the commentary out there is based on the yield curve between 10 and 2 years. And just to make it clear, because this is kind of inside baseball, yield curve sounds a lot scarier than it should. All you're doing is taking the yield on the 10-year, how much it costs the United States government to borrow for 10 years, and you're subtracting how much it costs to borrow for 2 years.
Yeah.
So the question you have to ask yourself is, should it cost more or less to borrow for longer? I would argue it should cost more because there's more time for things to go wrong, right? So what happens in a, quote, yield curve inversion, ooh, scary stuff. It simply means that it costs more to borrow for a short term than it does for a long term. In other words, in this case, with the 10-year, 2-year, it means it costs more to borrow for 2 years than it does for 10 years. And the question would be, why is that? It's because investors see more risk in the next 2 years than they do on the average over the next 10 years. And the 10-2 curve, if that inverts, that means that they expect a recession in the next 2 years. And that's useful information. It's not that useful because 2 years is a long time. So what I look at is I look at the 10-year 3-month curve. Because that way, if you're looking at, wow, they really expect more risk, which is to say a recession in the next 3 months, it's useful as opposed to 2 years. And what's interesting is if you go back and you look at the data, and actually I just did a blog post on this in some detail, you can see that the 10-year 3-month curve is a much more timely signal than the 10-2. And also, interestingly, that's what the Fed itself actually looks at. So I think what I'm looking for is timeliness. Because timeliness also means more reliability. So I look at the 10-3-month curve.
Okay. It's good. It's good to hear. And like I've talked about the media, I feel like ad nauseum. And if any part of that inverts, hey, the yield curve's inverted, and let's advertise some more about that or talk some more about that. But there's a lot of different metrics out there, and different parts of it have inverted at different times. And we've I feel like anyway, internally here at McCarthy and Cox, we haven't talked as much about the yield curve inversion because we got all these other things going on to talk about whether or is it a recession, is it not a recession, what do we do, and all that. So it was interesting, and I've seen a lot of different measures out there, and I was just curious which one you actually look at, as I know other people look at different things. It's just kind of all over the place, but that makes sense, and I appreciate your insight there. Are there any, one of the last questions here, are there any opportunities that you see right now other than just saying, hey, the market is constructive? Like we're at a much better place than we were, say, at the start of the year. If you want to buy you want to buy fixed income or look at stock valuations and things like that, we're at a more constructive place. Is there anything in particular that you see that looks more or less attractive right now than any other areas? Sectors, stocks versus bonds, anything like that?
Well, I think the real question is one way to express that question is what is mispriced? What do I see where the market expectations are out of line with what I see? And as I've said a couple of times, I actually see inflation continuing to go down, which means I expect to see real wage growth adjusted for inflation trend up. And I expect to see consumer confidence recover. Given all of that, I mean, we've seen consumer discretionary, we've seen it bounce pretty strongly, but I think there's probably still some room to go there. And the reason I say that is we still have a lot of people who talked about savings rates going down. That's true, but there's also still a lot of excess savings on the books from earlier stimulus measures that people haven't spent. As people start to feel better, they'll start to spend it. As people start to make more on an inflation-adjusted basis, they're going to go out there and they're going to spend some more. So I would be looking at consumer discretionary. I'd be paying attention to that. I think technology in general, people are going to be buying for growth, and interest rates probably are about as high as they're going to get on a long-term basis. So if we do get a recession, and as I said, we might in the next 2 years, they'd be positioned to benefit from a decline in interest rates. The other interesting thing is technology can be a play on the labor shortage, because when you go to McDonald's, for example, and you see that automated ordering kiosk, you go in and tap things, or if you go to Costco and you have the automated checkout and everything, they're not doing that because they wanted to buy those things. They're doing that because it's cheaper to buy those things than it is to hire somebody. If they can hire anybody at all. So technology is in an interesting position. From the macro perspective, it looks good. From a micro perspective, it makes a lot of sense. So I think those would be the two sectors I'm calling out.
Okay. All right. Thanks, Brad. I appreciate that. And actually, we'll make this here the last question for now. How much of an impact here have we seen from what's going on in China?
You see a lot of headlines, Wes, about China, and there's a lot of inside baseball going on there. You've got COVID, you've got some significant economic issues, principally in the real estate market. But here in the U.S., what that essentially boils down to is what has it done to our supply chains? And the truth of the matter is supply chains are still not what they should be. But again, getting back to our discussion earlier, are things getting better or things getting worse? Things are a lot better than they were, and they're continuing to get better. Now, the question is, can China blow up again and screw up the supply chains? And the answer, I suppose, is yes, but we've actually made considerable progress in de-risking our supply chains because of that. I mean, you've probably heard a lot of phrases like reshoring or friendshoring. Now, that doesn't happen overnight. That's going to be a 10 to 15-year project. But at the same time, that project has started. Companies have started planning for, okay, what happens if this happens? Nobody's getting caught flat-footed again. Is there a risk? Yeah. Is it as big as the risk we had? I don't think so. And it's going to get less every single year.
Okay. I appreciate that too. And just hearing a lot of this from you too, it's very reassuring. I know our clients really value hearing from you. We feel like longer term, and I'll say even longer term, if we look just beyond this year, beyond this, the doldrums that we're in right now, and look out a little bit, we see things getting better. It's just good to hear from others that it's not all doom and gloom, and this is not the end of the world. Because again, we want to keep our clients invested, and that's how we'll get to our longer term goals. So thank you, Brad, for joining us here. It's always really great to have you on. I know you've been to in-person meetings here. We've done webinars recently, but we really value the partnership. We value your opinion. I enjoy speaking with you and doing this. So thank you very much. I don't see anything else that's come in, so I'll go ahead and wrap this up. But again, thanks, Brad. I appreciate it. If anyone has any questions, follow-up questions, send those in here to us at McCarthy and Cox. This will be recorded and available on our YouTube channel. So we have to get it through compliance, but there'll be some point here in the near future. So again, thanks, Brad. I appreciate it. If you do figure out when we bottomed or what the top will be or when it will be, please let me know first, and then we'll disseminate that further.
I certainly will, Wes, and it's been my pleasure. Thank you very much.
Thanks, Brad. Thank you. Bye-bye.